What's up, everyone? Welcome to Investing by the Numbers. I'm Simon Thompson, and today we're going to cover the top 3 Canadian dividend stocks to buy and hold forever. So, whether you are just starting your portfolio or you're expanding on an existing one, these are 3 really strong stocks. In fact, number 1, TD Bank, makes up about 14% of my entire portfolio, and these stocks have a lot in common. They're all high dividend paying stocks. They all have great future potential and stable revenues. Plus, when you buy them, you're getting a little bit of diversification because they're all in different industries. So stay tuned. I'm going to break down a little analysis of each of these stocks so you can decide for yourself whether these seem like great investments for you. So let's start by looking at Toronto Dominion Bank. And this is the simple framework that I use to analyze a dividend stock. I start with the payout ratio, the dividend history, the insider holdings, as well as the revenue, profit, and book value. And if you want to learn more about these, you can check out my video, my top 4 time-tested principles for analyzing a dividend stock, and I'll include the link right here. You can check those out. Next, we'll cover the economic moat, which I'll explain in a little more detail, as well as the financial health, the earnings per share growth, and then I use the return on invested capital, which I won't be covering in today's video, just because I'd like to keep it a little shorter. And we also do our final piece of forward theorizing. What do we think is going to happen in the future? So we can use a tool called Simply Wall Street, which is $9 a month. I have no affiliation, but I find it really handy. And here we can see that the dividend payout ratio is 45%, which is a beautiful thing. We like to see it around 50% for most companies. And that's because we want to see a company being able to pay their dividend easily and be able to afford to invest back into growth. Another way to do that is to look on Morningstar. You can pull up the 10-year financials for free, and you can see that TD's payout ratio has been below 50% for over 10 years, which is absolutely amazing. We can also see the dividend history here on the financials, and we can see that they've been raising the dividends consistently over the past 10 years. And again, using Simply Wall Street, we can see that in a more visual format here, as they've been raising their dividend consistently. And when I crunch the numbers, they've raised it by about 9% on average per year. And with a simple Google search, you can discover that they've paid their dividend for 163 years straight. So we can also click here on management in Simply Wall Street and check out the insider holdings. And we can see that the CEO has 35 million worth of shares. The CFO has 22 million. And the group head of wholesale banking has 32.6 million. And we want to look at their compensation in comparison to this, because if their compensation is far greater than the amount they actually have invested in the company, that can be a warning sign. We want companies where the people who are making the decisions in the business are heavily invested in the long-term success of the business. Next, we can just check the revenue growth over time. And we can see here that they have been growing substantially. We can also check the net income line, which is also called the earnings, and that has been growing substantially. And we can check the book value per share, which also has been growing substantially over time. So we love to see this, and that wraps up the first 4. So again, if you want to learn a bit more about these first 4, you can check my video, The 4 Time-Tested Principles of Analyzing a Dividend Stock. And these are 4 principles that my father has used to return 17% annualized return over the past 27 years. So he's absolutely crushed the market performance, and I really recommend you check that video out if you're feeling a little bit lost so far. So next we'll talk about our economic moat, financial health, and earnings per share growth, which I'll explain. So using the paid portion of Morningstar, and this is a tool that costs $199 a year, and if you are significantly invested in the stock market over $10,000 or $20,000, I recommend getting it because they do some great analysis, and you can quickly see here they give an economic moat rating, and they say that TD Bank has a wide economic moat with a stable trend, which is their highest rating. Now, in simple terms, an economic moat is just when a business has certain attributes that protect its revenues and profits into the future. And in this case, they say that they have an economic moat because of cost advantages and switching costs. Basically, TD has cost advantages because they're the second largest bank in Canada, and they have a switching cost moat, which essentially is because the Canadian system is highly regulated and there's only a few key players, which limits excess competition and stabilizes product pricing, giving customers less incentive to switch banks. And again, it's also a pain in the bum to switch banks, so people oftentimes do not do that. Now, going back to simply Wall Street, we can click on financial health and get a quick snapshot of the overall assets versus liabilities. Now, for those of you who are newer, assets is simply a positive on the balance sheet. It means they have investments or ownership of property or other things like that, and liabilities is what they owe. So when I do the math and I add up their total assets versus their total liabilities, they have a net positive of about 90 billion in assets. Scrolling down, we can see a little bit more detail about their balance sheet here, and we can see that they have 410 billion in cash and short-term investments, which means they're in a very strong financial position. Finally, we'll check the earnings per share growth, and we can see that that has been growing significantly over time, and that is a product of the net income and also the total shares outstanding. And so sometimes, as we can see here, a business will buy back its own shares and reduce the number of outstanding shares, and this pushes the share price up. It's a simple case of supply and demand. And then other times, the number of outstanding shares rises, and this tends to push the share price down, or at least have negative pressure. Again, simple supply and demand. So it's great to see that their shares outstanding have remained fairly consistent over time. Plus, their net income has been growing massively. So this earnings per share number that we see is simply a formula of their net income divided by the number of outstanding shares. And we want to see that continuing to grow. So as we quickly review the analysis here in the Google Doc, I give things either great, good, fair, or poor, just a simple 4-point scale. And when we do forward theorizing here, essentially what we're trying to figure out is, are they going to continue to grow and return positive cash flows to investors? And what we're doing here essentially is we're actually betting on Canada and the USA, because TD Bank is heavily invested into the US. They've been expanding there. And of course, they are the second largest bank in Canada. So I'd like to think to myself, over the next 5 to 10 years, or even 10 to 15 years, are the US and Canada going to continue to grow? Are they going to continue to prosper? And my bet is yes, they will. Next, we're going to discuss Enbridge, which is North America's largest energy transportation business. And before we get too deep into that, I just want to ask you to hit the thumbs up button. It helps so much with the channel, guys. I really appreciate the support. If you're enjoying the content, please subscribe and ringy ding dong those bells to get notifications. Okay, Enbridge is a massive company. You can see here that they've just been dominant for a long time, over the last 30, 40 years, and recently their share price has slumped for the last 4 or 5 years, and I'll discuss that in more detail. So they pay out 7.5% currently, and we can see here their payout ratio is 112%. That's a big red circle, and that's no bueno. So we want to investigate that a little bit more. Next, we'll take a look at the dividend history, and we can see they've been raising it substantially. And as I read the annual report, they were discussing how they've raised their dividend for 25 years in a row. Next, we check the insider holdings, and we can see the CEO has a pretty substantial amount, and some of the other officers have an okay amount as well. Again, when we're looking at someone like this guy here, he only has 4.8 million invested, and his compensation is more than that in a single year. So that's not so great. Luckily, the CEO has a fairly strong position relative to his net worth. And we can scroll down here to the board members and we can see there's a couple of champions here. Our man Gregory Abel and David Toucher, who have 27 million each invested in the business. And this is what we like to see because the board members also have a huge effect on the direction of the company. David Toucher has been in this role for 14 years. Using Morningstar, we can quickly check the revenue over time here, and we can see it's been growing massively. We can also check the net income over time, and we can see that has also been growing very substantially with some interesting numbers in there that we'll explore in a minute. And we can also see the book value per share has increased massively over time, so that's great. Checking the Morningstar analysis, we can see they have a wide economic moat and the trend is stable, which is the highest rating. So this economic moat is the bread and butter of Enbridge, and this is because pipelines are approved by regulators only when there is economic need, and pipeline development takes about 3 years. So this type of oversight really limits competition, and once these networks are established, there's really no reason or incentive for competitors to come in to the exact same area. So what this means is that these pipelines are going to get used and competition in their region is going to be low. And here what we can see is the infrastructure map for Enbridge, and you can see they just have a huge network, and this just gives them a large advantage because they're already covering so much of North America and their network really cannot be replicated. Next, we can check the financial health, and we can see that they have about 70 billion in net assets compared to their liabilities. And scrolling down, we can see their cash and short-term investments is only 648 million, which may sound like a lot, but it's actually not since they're paying out such significant dividends and the debt is so high. So Enbridge is in a unique situation where normally during economic turmoil, pipelines tend to do very well because they just take their cut and people haven't stopped driving and flying and so on, so their revenues are stable even during difficult times. However, right now there's an oversupply of oil and the storage facilities are filling up to the very brim, and so there might be some serious underutilization of their pipelines in the near future. This may cause a cash crunch, and it is possible that Enbridge may have to cut their dividend temporarily. Finally, let's check the earnings per share growth, and we can see that that's been fairly solid, although it's a little all over the place. And again, earnings per share is a function of the net income, which we can see has been growing substantially, but also the number of outstanding shares. And if we take a look here, we can see that from 2016 to 2019, the number of outstanding shares has more than doubled. And what that does is it puts a lot of downward pressure on the stock price. And we can see it here. This is on the New York Stock Exchange, but you can also take a look at it on the TSX, which is the Canadian version. This is a dual listed stock. And we can see here that the downward pressure on this stock price really began in 2015 when they were issuing all those new shares. And so keep in mind, when they issue all these new shares, they are issuing it at the current stock price, and during those years the stock price was relatively high compared to their history, so they were raising a lot of money and then taking that and reinvesting it into the company into new projects. And so when those projects start to pay off in the next couple of years, you can expect that the revenues and net profits will grow. So right now the share price is suppressed, and that this is partly the reason why, and you might see a really good opportunity right now to get in and then cash in on those projects that are in motion later on. So going back to our analysis, we can say the payout ratio is poor, and I still have some questions that I want to answer there. The dividend history is great. The insider holdings are good/great thanks to our 2 board members. The revenue and profit and book value are also great. So continuing on, we have our economic moat, which is great, and it might even be great. So that's a 5 out of 4 stars, Tony the Tiger rating, very rare, and it's just because the economic moat is so strong with Enbridge. Remember, when we're buying a business, what we're actually doing is we're purchasing the future cash flows or the future profits of the business, and Enbridge just has very predictable future profits. The financial health is good. It could be stronger, but again, they have such a strong net positive in their assets position, and we also have to expect that pipelines are going to have high debt. You can imagine it like buying a house. You typically put down 10 or 20%, and then the rest is financed, and that's because you're buying a very stable asset with predictable cash flows. So that's why that whole mortgage system works in the first place. Pipelines are very similar. Now, the earnings per share growth was fair, not so great, but that's because of the new shares that were issued, not because of the recent net income. And so we need to keep that in mind, as there may be an opportunity to buy now while the share price is suppressed, and then benefit from the long-term extra cash flows that are created from those investments. So let's take a quick look at something called the DCF payout ratio. And this is basically an alternative way at looking at the payout ratio, and it's kind of standard for pipelines. And the reason is because, again, pipelines have a huge capital expenditure up front, but their cash flows down the road are so stable. So this special measurement takes a look at it in a different way when we're thinking about the payout ratio. And here we can see that Simply Safe Dividends does a great job of breaking this down for us. And they show us that pipelines, we like to see it typically below 70%. And right now it's at about 77%. So it's a little bit high right now. And as I mentioned before, it is possible that the dividend could get cut. But going back to our analysis, we have to be realistic here. The payout ratio is more in a fair area or good. We'd love to see the payout ratio come down. But again, we actually have to use this DCF payout ratio when we're talking about pipelines, and that is the distributable cash flows. So I can't explain that too much more right now because it's a little bit more complex, but I just wanted to touch on that and give you that info. So finally, that leaves us with our forward theorizing. We can say that the cash flows are super predictable from this business, and also that oil demand over the next 15 years is going to continue to rise. We can figure that out just from reading analysis. And we also know that natural gas is a necessity for heating our homes. So as much as we'd like to switch to alternative forms of energy, these forms of energy are still going to continue to be in large demand over the next 10 to 20 years. So this is a great long-term investment. And we need to keep in mind that companies like Enbridge are oftentimes the ones who are investing in other projects that are alternative energy. For example, they have a lot of wind energy projects. So Telus is the last one we'll cover. We'll go through it a bit faster than the first two. And I was buying this stock in and around this range here in the 21.5 price point. And we look at the last 20 years, they've been performing very well. Of course, this was the dot-com bubble crash, and this was 2008, 2009. So we saw some serious dips during that time. But overall, we've seen a lot of growth, and their current dividend yield is 5.1%. So I've filled out the analysis already. The payout ratio is good. It's at 77%. I'd like to see it a little bit lower, but the revenues are quite stable for Telus. Even during this crazy time, people tend to continue to pay their internet and phone bills. The dividend history is great. They've been raising their dividend consistently over time. The insider holdings are fair/good. The CEO has a decent amount of holdings, and there's one board member that has a strong holding. But other than that, it's a bit weak. So that's why I gave it that rating there. The revenue and profit and book value are great. The economic moat is good. Morningstar gives it a rating of narrow, which is they basically have a scale of none, narrow, or wide. And then they give the trend rating, and they say the trend is stable. The financial health is good with $0.5 billion in cash and $2.8 billion in receivables. So a lot of near-term cash, and their debt is a little bit high, but overall they're in a good financial position. And the earnings per share growth has been great. So when we check out Morningstar's analysis, they talk about expecting a 5% annual revenue growth over the next 5 years, which I think is a very reasonable estimate for Telus. And when we add that to the dividend, we can expect maybe a 10% annualized return for our investment at this time. And that's pretty solid given the level of safety that I would attribute to Telus, which just has very stable returns and a decent economic moat since there's not that many competitors. There's only maybe 3 major telecom companies in Canada, and they all have solid moats because they kind of have an unspoken agreement not to price cut against one another too hard. Furthermore, Telus has been upgrading their wireline network, which is basically just their internet network, and it is over 60% finished. And now in many areas in Canada, they are boasting the fastest download speeds, and also they have the lowest turnover of customers. So when they're acquiring customers, they tend to keep them for longest as compared to their competitors. Quick final note on Telus is that in Canada, there is less than 90% mobile penetration as opposed to 100% in the US and up to 140% in parts of Europe. And what we're talking about here is Canadians switching to wireless and using mobile phones. So there's going to be more and more of that over time. And so there's plenty of room in Canada for more people to be coming online, and all 3 of the major telecommunication businesses will benefit from that. So finally, with our forward theorizing, we can say that we're going to expect about 5% growth in revenues. These revenues should also be very stable even during difficult economic times, and they will eventually be able to raise their prices due to their better service offering as they continue to upgrade their network. So over the long term, I think this is a great buy and hold business, and I hope this gives you a quick outlook on Telus. All right, guys, so I just want to wrap up here with a couple of key points, but before we do that, hit that thumbs up button if you got some value from this. I really take a lot of time to make these videos, and I hope that came through. Plus, drop me a comment down below. Let me know what you think of my picks here, or if you have a favorite Canadian dividend stock of your own, let me know. I really love hearing from you guys. So finally, let's just discuss a little bit of context about these. Listen, I'm making this video in May 2020. I bought all of these businesses in March when things were really going down, and really I'm waiting for more opportunities when the market comes down again. Now that may or may not happen, and you have to really pick your own strategy. But the key point here is that if you decide to buy, make sure you do not panic if the share prices drop or even if dividends get cut temporarily. What we want to do is be focused on the next 5, 10, 20 years with these businesses, and if we think they're going to perform well over that timeline, then that is the decision we want to make, okay? We don't want to be worried about the short-term fluctuations. We want to think to ourselves, is Enbridge going to still be around in 5 years? Are they going to be growing in 5 years? And to me, the answer is yes. You have to make up your own mind, but make sure that if you do buy, do not sell, do not panic. Make sure you're comfortable with your investment. And of course, you can check out my free downloads below. One of them is the 12 principles for successful investing. And I think it really helps with your mindset when you're investing. All right, guys, that's about it for me. You can always check out my video, the 4 time-tested principles of analyzing a dividend stock. It explains a little bit more in detail why some of these principles are so important. So please check that out. All right, we'll see you next time.